My role at Lloyds Banking Group is to support businesses in the mid-market space, so that's companies with a turnover from 15 million up to listed PLCs. And I wanted to try and spend a few minutes this morning just sharing my thoughts and views on the economy and the challenges facing that wider mid-market space. The main part of this, however, is obviously the Q&A at the end of this morning's session, so looking forward to your questions and the debate from that. To say the economic environment we are currently operating is interesting and fast-changing is probably a bit of an understatement. We, as a bank, expect the economy to remain broadly flat through to 2014, with inflation falling sharply, commercial property values remaining broadly flat, and unemployment to drift up to around about 9% by the end of Q3. However, what continues to drive uncertainty in the markets is the continued threat of the Eurozone problems. Recently, European elections have left their scars on the global financial markets, and the Bank of England decision to cease, however temporarily, quantitative easing means the equity markets have lost ground, and we've seen new record low yields in core economies. Ongoing issues in Greece, the aftermath of the Greek elections and their continued failure to form a government, again raises concerns about Greece leaving the European currency and the wider implications on financial markets. Now, our own economic forecasts assume that any EU default can happen without large contagion across the Eurozone, and our assumptions put a 40% probability on this type of outcome, but a 20% probability of a slightly better position. Increasingly, however, it's looking more and more likely that contagion will result, and although how far-reaching we can't be sure, you couple that with the requirement for bank capital levels to increase and the ECB three-year loans to be repaid, that means that recession could easily result. So if I focus just on corporate Britain, or more specifically the mid-market space that I have more of an interest in, this economic landscape causes some concern around funding. I'll talk in a moment about the different funding needs of this market segment and the need to open up financial markets to alternative funding sources. But the question is, if financial markets seize up, how will businesses actually fund their growth? And I think, Mike, that's your challenge. However, the news is not all gloomy. Corporate business sentiment has risen strongly in Q1, and although April saw some consolidation in that, the net balance of firms' views about their own trading prospects for next year rose to its highest level for about 9 months. So generally, businesses are now more positive about their own company than they've been for some time. Now, this index tends to be a good lead indicator of economic activity and suggests that the UK's re-entry into recession is hopefully going to be brief. But we actually saw a similar scenario in H1 last year, with some positive early signs such as increased inquiries from corporates about growth funding. Indicators were good until we got into the Eurozone problems, and again that suppressed growth. Now we're at a similar crossroads, in my view, as we stand here now in 2012, where business confidence looks to be building, but that threat of Europe is hanging over us again. The mid-market space covers a diverse range of businesses, from SMEs at one end right up to the FTSE 250 lower-end investment-grade businesses. Now, as the market we're all operating has changed and evolved, the needs of this market have actually widened further. And within Lloyds, we try to split this market into what we call medium-sized businesses, those just above sort of SME definitions that have no access to capital markets, versus the big PLCs, which we refer to as kind of mid-caps. These are companies where the turnover exceeds 100 million and have more complex funding requirements. These defined segments of the market, in our view, require a different approach. So if I start with the medium-sized businesses, or the squeezed middle as it's sometimes called, it's firms in this space with a turnover usually between 15 and 100 million that really could create an extra 50 billion for the economy by 2020. The UK government and the media are very much focused on SMEs, and their media historically looks at corporate Britain as the large PLCs, but it's this squeezed middle that is most likely to create jobs and lead Britain into recovery. Now, whilst MSBs represent less than 1% of firms, they account for nearly a quarter of economic revenue, about 16% of employment. So to put it into context, SMEs count about 90% of firms and employ about 60% of the UK workforce, but only actually generate half of the UK's wealth. So that MSB contribution, however, is skewed across the space. Only 6% of them account for over 60% of job creation, and 65% of them achieving less than 1% employment. There is therefore a key sector to focus on our recovery, and the CBI research considers 3 factors in unlocking growth in this part of the market. First is to generate sufficient confidence and ambition to spur them into growth. The second is to build the skills and the competency within these businesses to actually grow. And the third is to have sufficient and appropriate forms of growth capital. Now, as a bank, we think we have a role in all these factors, and a significant one. The current economy has naturally impacted upon confidence and ambition, with just over a quarter of mid-sized businesses expecting to grow their business significantly over the next 5 years. But as champions of mid-sized businesses, we can help to bring confidence back to this market through a voice in government, sharing success in the media, and providing social networking across like-minded mid-sized businesses. Skills and competencies or lack of it are often cited as inhibitors to growth. But banks, as trusted advisors to their customers, should have the ability to introduce and share talented business people across sectors. Businesses in this stage of growth are typically either becoming a dominant player in the national markets or looking to expand overseas. And the move into international trading can be a big jump for these businesses. Banks should work to bring support and expertise alongside CBMI government to encourage businesses to actually take these steps. It is, however, I guess in the financing or access to capital that the bank's main responsibility to this sector lies. Now, historically, these fast-growing businesses were funded by private equity, leveraged finance. But since 2008, whilst private equity is still very much available, with equity houses opening and willing to provide investment, leveraged finance has all but dried up. Now, this means that either equity is required to fully fund acquisitions and growth, or alternative funding options have to be considered. Now, working capital lines such as invoice discounting, trade finance, export finance are becoming more widely used in this segment. But what was previously growth finance is more challenging, particularly given these mid-sized businesses don't have access to the bond and the PP markets. Leveraged finance is far more challenged under Basel III and regulatory changes. And if we considered how the leveraged businesses have performed since the recession, it is this type of financing that has the highest risk. You only have to look at high-profile examples such as Jaeger or Black's Leisure to see how highly geared businesses struggle when trading conditions tighten. So this type of funding in the long term is therefore, in our view, not a good way to fund growth, and it's not attractive necessarily to banks, regulators, or ultimately to the businesses themselves using it. So what is the bank's role if leveraged finance is not freely available? Well, post-crisis, we're not regulated to provide long-term debt. In fact, the mismatch between borrowing in the short-term wholesale markets and lending over long-term is partly what caused the financial crisis in the first place. Given companies need both long and short-term funding, the bank's role is to consider the short-term requirements, but importantly provide intellectual capital on both debt and equity to give businesses what they need to grow. Now, providing that intellectual capital as opposed to financial capital will be the new concept for some funders in the marketplace. But this change in dynamic will mean relationships between businesses and funders become even more significant. Banks do, however, need to step up and lend to the mid-sized business sector and should be able to do so building long-lasting, trusting relationships with strong, stable management teams. So if I move on to the mid-cap space, so that's businesses with a turnover exceeding 100 million. Whilst businesses in this part of the market have fewer issues finding the ambition to grow and building the right skills and competence, access to the right financing and growth and capital remains the key factor. As we move up that turnover band, companies grow in complexity, meaning that traditional financing methods are no longer the most appropriate, and accessing capital markets becomes more important for growth. Now, historically, the capital markets were only easily accessible by listed PLCs. So the challenge in today's market is to open this funding source up to a large number of customers. And over the past 12 months, net bond issuance was positive across most industrial sectors, but net equity issuance actually fell, meaning the total net amount of funds raised from capital markets by UK businesses is negative over the last 12 months. Again, the bank's role is critical here, providing that intellectual capital to support this funding change. Investment funds in the non-bank market will also play a role in financing these complex businesses. These funds have the capital, and they are ready to lend, but lack the distribution model to give access. They will have to work closely with those that have that distribution capacity, namely the banks, to make this funding more widely available. Banks will need to become the access and the bridge into other pools of liquidity. Now, markets like the bond and PP markets exist in the US, but not in the UK as yet. Here in Britain, we do have the equivalent sources, but there isn't yet the channel between that liquidity and distribution. So I've talked about the economy as well as the changing funding needs of different market segments. In this current economy, there is depressed demand for debt in the market, with lending to UK businesses down 3% in the 12 months to February. And despite what the media may say, banks are lending and debt is actually not an issue for this part of the market space. Businesses are proactively deleveraging and cash stockpiles are growing, with cash and corporate balance sheets growing month on month. But what about when investment returns, as the economy picks up whenever that might be? Debt funding will rapidly return to this part of the market. And conversely, it is also this growth period where historically you see the highest number of business defaults. Will the banks have the appetite, balance sheet and liquidity to support the required level of growth? Well, the bank crisis has fundamentally changed the level of regulation in the debt market, but also the players within it. Regulation is now restricting balance sheet growth and capital available for investment at the same time as foreign banks have retrenched back to their native soils. Will the UK industry be sufficient to provide enough debt and investment to support growth? Well, of course, we have plans in place to ensure we can do this, and this part of the market is less impacted by changing regulations such as Basel III compared to, say, investment banking. So banks should find this sector a key area of focus and an attractive one. In our case, our non-core book, i.e. those businesses that we don't see part of our strategic future, is being run down to create more capacity for when growth returns. This, in our case, has to be matched more with growth of our core business. We're also working closely with our customers and our prospect base to bring forward refinance or war chest opportunities to spread out the expected uptick in debt demand. That said, the question still remains, given the length and depth of this recession, how quickly businesses will grow and investment returns, and how well placed is the UK bank market to actually meet this. Now, through these turbulent times, the relationship between Lloyds and our customers has had to move forward. We have had to up our game in the way we interact with the market and how we face into our customer base. This change is most obvious in the way we communicate with our customers. And historically, we've relied upon teams of relationship directors to be that communication channel. But as the market grows, we need to share intellectual capital increases. We have moved to more sophisticated methods of communication and multiple links into our customers using wider and greater skill sets. And as new generations of businesses and people move into the corporate market, we will need to continue to change and evolve the way in which we operate and interact with our customers. Whatever does happen as we go through the next few months of instability, one thing is for certain: we will not go back to the free availability of low-cost, covenant-light debt that we saw in the run-up to the banking crisis. The reality is we have been in this position before. When we came out of recession in the 90s and again in the early 2000s, we did it in a sustainable way. It was only in the 5 years really running up to 2008 that we saw that real explosion in terms of debt in this market. So we need to be realistic and not have an expectation that 2007 and 2008 were the norm. Thank you.